Hello, this is Brian Belski, Chief Investment Strategist at BMO Capital Markets. We believe North American stocks will post their fourth consecutive year of positive returns in 2022, albeit less positive, but that is very okay and very normal. With respect to U.S. stocks, our models show that the S&P 500 index will attain a price objective of $5,300 on earnings of $245. With respect to Canada, our TSX models show a $24,000 target on earnings of $1,500. To clarify even further, we believe this less positive trend does not only apply to price performance, but also less positive earnings growth and diminished valuations, not to mention a slowing trajectory of rising interest rates, and yes, the strong possibility of decelerating inflation in both countries, especially during the second half of 2022. Simply stated, double-digit earnings growth, still excessively low interest rates, declining valuations, and eventually subdued inflation are a very good backdrop for equities. Equities are traditionally the best inflation hedge, and yes, stocks can, will, and should go up alongside interest rates. After all, rising bond yields means the economy is improving, which the stock market has already been telling us thanks to its powerful rally the past few years in both the United States and Canada. In terms of positioning over the next 12 to 18 months for North American clients, we're advising the same sectors to overweight: financials, discretionary, industrials, and materials, while equal weighting both growth and value in both countries, let alone small, mid, and large cap stocks. However, clients are encouraged to differentiate these positions by increasing their focus on quality, growth at a reasonable price, and dividend growth across all size, styles, and sectors. Taking a bit of a longer-term picture with respect to North American equities, we continue to believe the U.S. is in a 20 to 25-year bull market, and Canada's coming along for the ride. After all, as America goes, so goes Canada. However, over the next 3 to 5 years, we believe returns are going to become more normalized in both countries to the tune of high single-digit to low double-digit returns, with longer-term time horizons with respect to sector positions in both countries centered around technology, communication services, discretionary, and financials. To be clear, society has been nothing less than tumultuous the past few years. However, equity markets around the world and investing in general have been very exciting to say the least. But as markets, let alone society itself, begins to normalize and moderate over the next few years as the great unwind of the COVID-19 pandemic ensues, we continue to focus on the positive because after all, positive is still positive.